Hello everyone. Today we are going to talk about cash flow statement, operating activities, the direct method. This is the less common method than the indirect version. Let's do a quick recap. For the operating activities, we have two methods of showing it. One is the indirect method you probably are more familiar with, which starts with the net income. Then after the net income, we make adjustments for non-cash items such as depreciation, gains, etc. As you know, this is the most common in practice. And also in the CPA exam, most of the questions are coming from the indirect method. Today we are talking about the direct method. This method is more detailed. Probably that's why a lot of companies do not prefer this one. But basically, with the direct method, it lists all the gross cash receipts and payments, such as cash from customers and cash to suppliers. In the end, we got the cash amount. Either method gives us the same result. It's just a preference how to report them. Okay, so what does the Drake method do? So it basically converts accrual-based income statements into their cash equivalent. So the same thing we were doing with the indirect method, we are just doing it differently. How do we do it? We start from the income statement, accrual-based information. Then we are adjusting the changes related to balance sheet accounts. And then from there, we reach our final number. So the importance of this number is that it is giving us the liquidity information about the company. Okay, so how do we calculate cash received from the customer? Look at the formula. It's very simple. We start from the sales revenue and make adjustments based on the accounts receivable and the deferred revenue. I want you to pay attention here because for the accounts receivable, there is an inverse relationship, and for the deferred revenue, there is direct relationship. So whenever you are doing a questions about cash flow statement, a lot of the time it's the opposite. That's why this statement takes longer for a lot of students to fully comprehend. But once you understand the logic, it's not that hard. So for the accounts receivable, there's an inverse relationship. If the company has more accounts receivable, that means more people of the company, so they have less cash because we have more people tells us, okay, I owe you, but they did not give us the cash. And if you see that there's a decrease in the accounts receivable, that means people are paying their debt to the company, so we have more cash. For deferred revenue, there's a direct relationship. If there's an increase in deferred revenue, more cash was received upfront. Okay, now let's review the formula for cash paid to suppliers. Here, basically, we are getting the accrual-based cost of goods sold and converting into cash basis. Here, there's a little bit more moving parts, but basically, we are making adjustments by looking at the inventory and accounts payable. And how do we do this one? So basically, if you see an increase in the inventory, it means we bought more than we sold. So we are adding it to cost of goods sold. And if you see a decrease in the inventory, that means we sold more than we purchased. So we are deducting it from cost of goods sold. So for this one, think about the relationship. Okay, did the inventory increase or decrease? If it increase, that means we have more goods that we sold, and if it decrease, it's the other way around. And for accounts payable, if there's an increase, that means we did not spend as much cash. We got a lot of things on credits, so we are deducting it from cost of goods sold. And if you see any decrease in the accounts payable, that means we are paying our debt. And in this case, we are adding it to cost of goods sold. Here you can, like the accounts payable is the same thing. Think about debt. If you pay the debt, that means you have less cash. If you have more debt, you have more cash. Let's look at the cash paid for operating expenses. The logic is the same here. We are starting from the accrual-based expenses and converting it into cash basis expenses. For adjustments, we are looking at both prepaid expenses and accrued liabilities. In the question, they are either telling us there is an increase of prepaid this much or decrease of that much, or they give us the two statements and you need to look at the prepaids and the accrued liabilities amount to see the differences. You need to start thinking of under what circumstances the company has more cash. If you prepay more, or if if you pay off debt, your liabilities decreases, you have more cash. So by this logic, if you see there's an increase in the prepaids, we are adding. And if there's any decrease in the prepaids, we are subtracting. If there's an increase in the liabilities, we are subtracting. And if there's a decrease in the liabilities, we are adding. Like they can get confusing. Always think of start from what are we trying to do. Like in this case, we are trying to convert from accrual based expenses into cash basis. And from there, think of how it would affect the cash. No matter how much you study, those formulas can get overwhelming, or even if you memorize it well, you may forget it because of exam stress. For this one, I recommend you to use this good old T method. So for this one, if you are not sure about the formula and you are looking for a number, just create the T chart and start filling the beginning balance and the ending balance. Then you can enter the accrual amount. So like in this example is the sales. Then from there, you can easily find the number you are looking for. Let's talk about a common exam trap you may see with the Drake method. It's about depreciation. Remember when I was talking about operational expenses, excluding depreciation or something like that. So the reason behind that is because when we are working with the Drake method, we do not do anything with depreciation. We ignore it. Why? Because with the Drake method, we are basically working everything with directly, and with the depreciation, there is like nothing involved. So it's a non-cash expense. So it has no cash impact. So we are ignoring it. They like to test this because with the indirect method, which starts with net income, we add the depreciation. But for the Jack method, it only tracks cash in and cash out. So if there's no cash impact, we ignore it. Okay, let's do a couple practice questions to make everything easier. This one is about cash from customers. It is asking us to calculate cash received from customers. Remember the formula, we are looking at the accounts receivable and the deferred revenue. And here it is giving us the beginning and the ending information. So we are going to look at the differences from them. And one other thing in those questions, sometimes it gives you the net income. So if you see the net income, most of the time, we are going to use the indirect method. Here we have the sales revenue, which is 500,000. And accounts receivable, we see there's a $20,000 difference. Basically, we have more accounts receivable. Remember, it has inverse relationship here. And for the deferred revenue, we are looking at the deferred revenue. Beginning of the year, we had 10,000, ending of the year, 5,000. So there's a $5,000 difference. We have all those four options. I'm going to give you a minute. And on the next screen, we're gonna just do the solution together. Okay, so the correct answer is B, $750,000. And how did we calculate it? Think about the logic. We sold for $800,000, but the customers owe us $500,000 more than before. So that means we did not collect the $50,000 yet. Our sales revenue was $800,000. When we look at the changes in the accounts receivable, we see that it increased for $50,000. So the cash collected is $750,000. Okay, so the second question is about the cash paid to suppliers. It starts from the cost of goods sold. We are going to convert from the accrual basis to cash basis here. It's asking to calculate the cash paid to suppliers based on the following. Inventory is increased for $20,000. So that means, remember, if there's more inventory, we bought more than we sold. So the cash decreased. And for the accounts payable, beginning of the year we had $20,000, end of the year we have $15,000 accounts payable. What does it mean? We paid off our debt. So we have $5,000 less debt here. Okay, we have all those four options. I'm going to give you a minute, and on the next screen we're gonna do it all together. Okay, the correct answer is C, $330,000. How did we find this number? Let's look at the logic again. As we talked earlier, we bought more inventory, so that was cash out for $20,000. And we paid off our all debt, which is the cash out, for $10,000. They are both increasing the cash payments, so cash paid is $330,000. Here it's asking us net cash provided by operating activities. This is how much cash we received from the customers. We paid to them 120. Cash paid for operating expenses 40. Cash paid for interest is 10,000. And cash paid for dividends is $20,000. I'll give you a minute here, and once you're ready, we can go to the next screen. Okay, so for this one, the correct answer is B, $30,000. Let's look at the items one by one. The biggest difference here, the confusing item could be the dividends paid, $20,000. We ignore it because it is asking us the operating activity, and the dividends paid is a financing activity, so they are not going to be included here. So we start with $200,000 customers, then we deduct 124 suppliers, then the 44 operating expenses, and the interest paid is always operating. We deduct this one, so our net cash flow is $30,000. Okay, also there is a very specific SB rule for the Drake method that can trip off exam takers. It's basically if a company chooses to use the Drake method, they also needs to provide a reconciliation of net income to net cash from operating activities. So basically, if you are using the indirect method, you start from the net income, then you from the cash, so it's basically just a statement. Much easier. That's why 95% of the companies choose this method. But if you choose the direct method, you create the statement plus a reconciliation schedule. So you're doing the same work twice. So let's do a quick recap and summarize everything we discussed so far. So basically for the direct method, it reports the gross cash receipts and payments, like customers, suppliers, and employees, instead of adjusting the net income like the indirect method. It's based on the major classes. The conversion logic is for the assets, it's an inverse. We are subtracting. For the liabilities, there's a direct relationship, so we are adding it. One other thing, if you are using the direct methods, you also need to have a supplementary schedule for reconciliation. It's called net income to operating cash flows for the exam. So most of the questions will come from the indirect method. But how do we understand if they're asking us direct method questions? So they're asking questions like a specific line item. Say they're asking like cash paid to suppliers, cash collected, like the examples we just did. Okay, this completes the fourth video of our cash flow statements. Thank you for watching and see you on the next video.